The market just vaporized more than $6 trillion in about an hour. Gold dropped like someone cut the rope. Silver fell off a cliff. And if you think this was just volatility, you're about to get taught the hard way what actually controls this game. You just watched gold go from the high 5,000s to the low 5,000s in one ugly rush. You just watched silver slide from the 120s to near 108 like gravity got turned up. Stops snapped. Leverage accounts got margin called. Forced selling triggered more forced selling, and the chart turned into a waterfall. Now listen to me. The crash wasn't the story. The mechanism was. Because the same hidden lever that slammed metals today can launch them tomorrow. And if you understand that lever, you stop being the person providing exit liquidity. You become the person waiting for the scream. This is the breakdown. No fluff, no coping. Just the wiring behind what you saw. Subscribe now if you want the real mechanics instead of headlines. Here's what happened, clean and fast. It's January 29th, 2026. Around late morning Eastern Time, gold was trading near 5,600. Silver was sitting around 121. About an hour later, gold was near 5,100 and silver was near 108. That's hundreds of dollars per ounce erased in gold and double-digit dollars per ounce erased in silver in the time it takes to drink a coffee. If you were fully unlevered and long-term, it was pain on a screen. If you were leveraged, it was a guillotine. Because when price drops that fast, margin does not negotiate. Margin executes. Your broker doesn't care about your thesis. Your broker cares about collateral. The moment your account breaches maintenance, your position becomes a liquidation event. And one liquidation becomes the spark for the next one. That's why these moves look like mystery crashes. They're not mysterious, they're cascades. But cascades need a trigger. And today's trigger wasn't gold suddenly became worthless. It wasn't silver demand disappeared in 60 minutes. The trigger was the one thing most retail traders refuse to watch. The dollar. Not the concept of the dollar, the index, the pressure gauge, the thing that tells you whether gold and silver are about to inhale or choke. It's called the DXY, the US Dollar Index. It measures the dollar versus a basket of major currencies. When it rips higher, it's like someone tightens a belt around dollar-priced commodities. When it dumps, it's like someone opens the valve. And the relationship is brutal because it's mechanical. Gold and silver are priced in dollars. When the dollar strengthens, it takes fewer dollars to buy the same ounce. So the dollar price of the ounce falls, even if the ounce didn't change. When the dollar weakens, it takes more dollars to buy that ounce, so the dollar price rises. A lot of people treat that as a correlation, like it's a vibe. It's not a vibe, it's arithmetic. The chart is the smoke, the dollar is the fire. So what happened today? The dollar surged, the DXY spiked, and metals got crushed because the world repriced the unit of account. That's the first layer. But I promised you the wiring, so let's go deeper, because the dollar doesn't spike for no reason. It spikes because capital is stampeding towards safety, yield, or both. And today, three forces stacked on top of each other like a set of dominoes. Three. And when they hit in the same window, the market doesn't dip, it snaps. Force number one, interest rate expectations. You don't need to be a bond nerd to understand this. When the market believes rates will stay high longer, the dollar becomes a magnet. Higher yields pull foreign capital into dollar assets. That capital has to buy dollars to buy treasuries and US paper. Demand rises, DXY rises, and metals, priced in dollars, fall. That's the macro lever. Force number two, growth fear tied to China. Silver isn't just a shiny asset people stack in a safe. Silver is a factory metal. Solar panels, electronics, power systems, EV components. Industrial demand is a big chunk of the story. So when markets sniff slower manufacturing, softer output, or weaker momentum out of China, they don't just price less growth, they price less industrial pull. And silver feels that punch harder than gold. Gold is the monetary metal. Silver is the hybrid, part money, part machine. In a risk-off shock, silver often takes the worst hit because traders treat it as the high beta version of gold. Gold moves, silver moves farther, in both directions. That's why silver can make you look like a genius on the way up and erase you on the way down. Force number three, political deadline risk in the United States. You can call it theater, you can call it dysfunction, but markets call it uncertainty, and uncertainty makes funds de-risk. When a shutdown deadline hits the calendar, traders don't wait for the vote. They reduce exposure. They take profits. They cut leverage. They raise cash. And after a huge run-up, profit on the table becomes gasoline. Because there were a lot of people sitting on gains. Gold had been flying. Silver had been screaming. Everyone felt smart. Everyone felt early. And that's exactly when markets look for a reason to punish comfort. So you had rates expectations leaning hawkish, growth fear hitting silver's industrial narrative, and a political deadline pushing funds toward cash and safety. Then the dollar popped. Then the cascade started. And $6 trillion didn't disappear. It changed hands. That phrase matters, because wealth doesn't evaporate in markets. It transfers. From the late to the early, from the leveraged to the liquid, from the emotional to the systematic. Now here's where most people get tricked. They watch gold and silver fall and they assume the metals story broke. They assume the bull market ended. They assume the thesis is dead. They panic sell the thing they wanted for protection because the screen turned red. That's not analysis. That's motion sickness. To understand what happens next, you need to separate two worlds: paper behavior and fundamental pressure. Paper behavior is the dollar spike, the margin calls, the stop hunts, the option gamma, the liquidations. It's violent and fast. Fundamental pressure is the long-term drivers: fiscal reality, currency competition, central bank behavior, industrial deficits, supply constraints. It's slow and persistent. Today was paper. And paper can move price massively, without touching the core reason you own the metal. Here's a simple test. Did the world's debt shrink by $6 trillion today? No. Did budget deficits disappear in 1 hour? No. Did long-term monetary competition vanish? No. Did mines suddenly flood the market with new supply? No. So what changed? Sentiment and positioning. That's it. And that is why crashes inside bull markets often become the setups for the next expansion, not the funeral. But I'm not going to sell you comfort. I'm going to give you the pattern, the risk, and the map. Because yes, there's a pattern here. And it's uncomfortably familiar. We saw a near copy of this structure at the end of December 2025. A sharp, ugly drop. Panic, liquidations, everyone calling the top, people posting screenshots of losses. Then January arrived and the market did what it loves to do. It punished the people who sold fear. Gold ripped, silver ripped harder. It wasn't a gentle recovery, it was a launch. So the question now is the only question that matters. Is this the end of the move? Or is this the reset before the next leg? And before you answer, you need to understand something about silver that most people learn only after it hurts. Silver is not a slower gold. It is a lever. If gold is the base rhythm, silver is the amplifier. When gold moves one, silver often moves two. When gold breathes, silver sprints. When gold sneezes, silver gets pneumonia. That's not drama. It's volatility structure. Silver's market is smaller. Liquidity is thinner. Speculation is heavier. And the industrial narrative makes it sensitive to growth shocks. So in a dollar spike plus risk-off wave, silver doesn't politely step down. It jumps down the stairs. That's why today's drop felt personal. And that's why the rebound, if it comes, can be violent. Now let's talk about what people misread. Some of you noticed earlier this week there was a silver-heavy drop where gold didn't move much. That type of divergence usually signals a silver-specific driver, industrial fear, positioning, or sector flow. But when gold and silver both get hit together in a tight window, that's your clue you're looking at a macro driver. Dollar, rates, broad risk. That matters because it tells you what to watch next. Not your feelings, not the comment section, not the latest hot take, the indicators. And there are 4 I want you staring at like a hawk, because they'll tell you whether today was a one-off flush or the first crack in the floor. Number 1, the DXY. If the dollar keeps climbing, metals can keep bleeding. Not because the metals are bad, but because the unit they're priced in is strengthening. If the DXY rolls over, metals can rebound fast because the pressure reverses. Number 2, rate messaging. Whether it's official policy or just guidance, markets trade expectation. If traders believe cuts are delayed and rates stay higher longer, the dollar gets support. If the messaging softens, metals catch a bid. Number 3, China headlines that hint at stimulus or deeper slowdown. Stimulus talk can light a match under industrial metals and silver. More contraction fear can keep silver under pressure. Number 4, Political deadline resolution. Uncertainty pushes de-risking. Resolution removes the excuse, and markets love excuses. Now you might be thinking, okay, so what do I do right now? That depends on which bucket you're in, and I'm going to be blunt, because blunt is what saves accounts. Bucket 1. You own physical metal as long-term insurance. If that's you, the correct move is usually the most boring move. Don't do anything stupid. Physical metal isn't a weekly options trade. It's not a dopamine chart. It's a savings vehicle and a hedge against system risk. If you bought for protection, you don't throw it away because you had a rough hour. You don't cancel your insurance policy the day you see a storm. If you're rattled, zoom out. Your ounces didn't vanish. The screen changed, not the metal. Bucket 2. You were trading, maybe with leverage. If that's you, today wasn't unlucky. It was a warning label. Leverage in metals is like driving a sports car on black ice. You can be right on direction and still get wiped because timing and volatility decide your survival. Stops can slip, gaps can jump, liquidity can vanish, and the moment it goes wrong, the market doesn't let you fix it. It liquidates you. If you insist on leverage, cut it down until you can survive a move like today without blowing up. Better yet, structure it so you can be wrong and still be alive, because survival is the whole game. Bucket 3. You're sitting in cash, watching the blood. This is where opportunity lives, but only for people who can act without going all in like a gambler. The mistake isn't buying dips. The mistake is thinking the first dip is the last dip. In volatility, you scale. You do it in tranches. You plan for the possibility that price overshoots lower. You decide in advance what you do if it drops another 5%, another 10%. You don't improvise while your adrenaline is spiking. Now let's deal with the hard emotional part. If you bought near the top, you feel stupid. You feel betrayed. You feel like the market targeted you personally. It didn't. You just got caught in the most common trap in finance, chasing confirmation after a move. Everyone loves the trend when it's already obvious. Everyone buys when the chart looks safest. And that's exactly when the market can do the most damage, because that's where stops are clustered and leverage is thick. Bad timing is not automatically a bad thesis, but it becomes a catastrophe when you combine it with leverage and panic. So here's the real fork in the road. Do you make a temporary drawdown permanent by selling into the flush? Or do you hold through volatility because you still believe the larger driver is intact? Only you can decide that, but you cannot decide it intelligently unless you know whether the fundamentals shifted or the positioning shifted. Today was positioning. Now I'm going to give you scenarios, but I'm not going to pretend I have a crystal ball. I'm going to assign probabilities like a risk manager, not a fortune teller. Scenario 1. This is a shakeout inside a continuing bull trend. The dollar spike fades, the panic exhausts, the market finds footing, buyers step in, and metals reclaim levels that felt impossible today. This is the December flush, January launch analog. Scenario 2. More downside before the real bounce. The dollar holds strength. Rates expectations stay tight. Growth fear deepens. In that case, gold can probe lower support, and silver can test levels that make your stomach turn, even if the longer-term trend eventually survives. Scenario 3. The chop cage. Price goes sideways and nasty, whipsaw moves that punish both bulls and bears. Boredom drains attention. Retail gives up. Then the next big move arrives when the crowd is asleep. Now here's the part you need to hear carefully. The market loves to create maximum regret. It will drop hard enough to make you sell, and then rally hard enough to make you chase, and then drop again to punish the chase. That's why the real edge isn't a prediction, it's a plan. So here is the on-the-record call I'm making, based on the pattern, the oversold impulse, and the calendar pressure. I expect silver to reclaim the 120 area by mid-February, assuming the dollar spike cools and the political deadline resolves without escalation. And that assuming is everything, because the dollar is the steering wheel. If DXY stays elevated and keeps climbing, metals can stay pinned longer than you think. But if DXY rolls over, silver doesn't walk back up, it snaps back up. That is the nature of a leveraged market. Now let me ask you 2 questions, and I want real answers, not coping. Do you think today was a controlled flush to reset positioning? Or do you think it was the first crack of something uglier? And what are you watching more closely right now? The metals charts or the dollar index? Drop your answers below because your answer tells me whether you're reacting to smoke or tracking the fire. Now, let's make this practical, because information without application is just entertainment. Here's a simple checklist for the next 2 weeks. First, watch DXY daily. Not obsessively every 5 minutes like a hostage, but daily like a pilot checks instruments. If it's still rising, don't be shocked if metals struggle. If it turns down, expect speed in the rebound. Second, listen to rate language like it's a weather report. Markets don't wait for policy. They trade expectation. If the tone shifts even slightly, it can change flows instantly. Third, respect silver volatility. If you cannot handle the emotional drawdown of silver, don't size it like a hero. Silver doesn't reward bravado. It rewards discipline. Fourth, don't confuse being early with being wrong. If you have a long-term thesis and you sized it responsibly, volatility is the price of admission. If you sized it like a lottery ticket, volatility is a death sentence. Now I'm going to close with something most people hate hearing, but it's true. Today didn't ruin you. Your structure ruins you. If your plan required price to only go up, you didn't have a plan. You had a hope. If your position size forced you to stare at the screen in panic, you were oversized. If your leverage made you vulnerable to a 1-hour flush, you weren't investing. You were gambling in a market designed to punish gamblers. And if you learned that today, then today wasn't just pain. It was tuition. Because the next crash will come. There will always be another flush, another headline, another unexpected move. Markets are engineered to shake out the weak, not to reward the righteous. The only question is whether you will be ready. So here's what I want you to do right now. If you found this breakdown useful, hit like so more people stop getting blindsided by the same mechanism. Subscribe, because I'm going to track the dollar, rates, and the follow-through into early February, and I'm going to call it clean, no hype. And if you know someone staring at a red screen right now, send this to them. Not to soothe them, to wake them up. 6 trillion didn't vanish today, it moved. Next time, make sure you're on the right side of that transfer.